All right, a very warm welcome to you wherever you're joining us from. Welcome to MyChat with the Bank CEO. And today being Friday the 7th, of course, we have a wonderful conversation that is lined up for you. So stay tuned. This is where you get all the insights on what's happening in Kenya's banking industry. Remember, this is a series of conversation on what's happening in the banking industry. We're looking and exploring conversations from a banking and financial perspective. Now, today's conversation is part of this series that we have been bringing to you for the last couple of weeks, and we will continue to bring these conversations to you as we go along. We are live on X, we are live on LinkedIn, and we are live on YouTube. That's where you can find and follow the conversation. At Kenya Bankers is the handle to follow. At Jim Cario is where you can find me. My name is Jimmy Mbogo, and I will be taking you through this conversation today. And we are looking at this conversation and the topic for today that we will be handling is driving financial inclusion through digital banking and MSME support. Let me repeat that. We're looking at driving financial inclusion through digital banking and MSME support. I will be in the company of Mr. Ralph Opara. He is the country managing director of Access Bank. He'll be telling us where he's been hiding and what are some of the insights that he has. Mr. Ralph, good morning.
Good morning, Jimmy. It's great to be here. Thank you for having me.
Wonderful. Are you ready for the conversation today?
Yes, I am.
All right, perfect. So for those who are yet to understand who Mr. Ralph is, again, like I said, he is the managing director, Access Bank Kenya. He's a seasoned banker and a senior member of the Chartered Institute of Bankers of Nigeria. He previously served as the group head of Access Bank Commercial Banking Division, which he grew into the group's largest commercial business. How about that? And we just want to start this conversation and get into this conversation, Mr. Ralph. And first of all, I want to give you this opportunity to make your opening remarks, and then we'll pick it from there with a couple of questions. And for those of you who are following this conversation online, remember to send in all your questions, and we'll be sampling some of them as we go along during this conversation. Please, if you're on X, that is where you can send the questions. If you're following this conversation on YouTube, just on the comment section, please share your questions, and we will be sampling to some of them as and when you send them in. But Mr. Ralph, the floor is yours. Make your opening remarks.
First, Jimmy, thank you for having me. Let me express my appreciation to you and the Kenya Bankers Association for this very impactful session that is focused on creating businesses within Kenya and across the region. I'll start by telling you who I work for. I work for Access Bank Kenya PLC. It's a subsidiary of Access Bank PLC. Access Bank PLC, as you know, is headquartered in Lagos, Nigeria. We serve our customers through two critical business segments: wholesale banking, made up of corporate, commercial, and public sector, and the retail banking segment. And of course, we serve our customers with our over 700 branches. When we talk about the group spanning 3 continents, Africa, Europe, and Asia, serving over 60 million customers globally. We're in over 20 countries globally. And the merger in 2019 between Access Bank PLC in Nigeria and Diamond Bank created what is called the largest African retail franchise by customer base, serving over 60 million customers, and the largest bank in Nigeria by total assets. So we come from a formidable base. And then here, bringing it home to Kenya, is that recently the Access Bank Group recently acquired National Bank of Kenya. And so I'm happy to announce that pending the amalgamation of these two institutions, we've been able to integrate our service delivery channels. What does that mean? It means that customers of Access Bank can walk into National Bank of Kenya branches and consummate their transactions, and vice versa. So that basically gives us scale across our over 100 branches in Kenya. Thank you.
All right, wonderful. And that is quite a way to start the conversation. And I just want to take you back. You're talking about being the bank with the largest customer base on the continent. And I want you to help us understand, when you talk about financial inclusion, what does that look like? Is it just being able to, is it just having a bank account, or is it being able to access credit? What does financial inclusion look like from where you sit?
Okay, no, it's not just about having a bank account. First, let me even start with a bit of statistics. When you look at formal financial access within Kenya, I think Kenya has done well. About 85% of the population have formal financial access, which is pretty good for Africa. However, What that statistic means is that 1 in every 10 Kenyans is financially excluded. So for us as a bank, financial inclusion is creating financial products that basically don't conform with the traditional methods of profiling customers and giving them access to bring them into the formal system, creating products that enables people without ordinarily that don't have the opportunity to have financial access to come into the system. And basically, a tool or a way you can promote financial inclusion is through, of course, mobile banking. And then, of course, internet banking and all those digital platforms that you can do. It's a fantastic way to provide service and reach to the unbanked.
Yeah, and speaking of the contribution of mobile banking, that is one of the things that we can credit financial inclusion with, and especially here in Kenya, because initially, even just having a bank account was quite a challenge. And speaking about mobile banking and digital inclusion, I want to know, what do you think mobile banking did for customers that banks were not doing at the time?
First of all, it eliminated the traditional barriers to having access to finance, which is that previously, if you wanted to have financial access, you had to walk or go to the branch. In some cases, at least within my recent tours of Kenya, some people go as far as 50 kilometers to get to the nearest bank. So what mobile banking did and digital banking did is to ensure that you eliminate distance and cost to the customer, where they can transact or access a financial service through their mobile phones. That's something it did. So eliminate access in terms of distance and cost.
Yeah.
Secondly is that it provides convenience. So based on the fact that you can reach previously unreachable customers through their mobile phones, that gave us the opportunities to begin to look at creating products using alternate data-driven credit models to structure credit programs that would make it bankable for people that otherwise would not have fit the traditional banking credit models to gain access to finance. So that's something that it's done. So what that means is that people now have access to credits.
Yeah.
People now have access to just normal pay and receive platforms through their mobile banking. At Access Bank, we have a mobile banking platform called the Access Mall. And through the Access Mall, we create credit programs like the instant business loans. And so a recent product we're about to launch called the DigiFarm that provides credits to farmers, tea planting farmers within the Kenyan space.
Yeah, and actually that brings me to my next question, Ralph, which is the question of, much as we say that Kenya has made a lot of progress when it comes to financial inclusion, there is still a population that is unbanked. And the question is, what then do banks need to do to reach out to this customer base?
Okay, the good thing about it is partnership and collaboration is important. A lot of banks, we have to partner with both the fintechs, the telcos, the agent networks, and then look for other digital means to reach them. So for instance, not everybody has a smartphone. Some people have a typical feature phone. How do you reach customers in that have those kind of feature phones? One is the USSD code, where you can type a star sequence of numbers, and then the individual has access to savings products, lending products, and if possible, investment products. The voice prompt, where you can dial into a banking channel, and then through a voice prompt, it takes you through step by step through channels that can help you in terms of savings, literacy programs, lending programs, etc. But most importantly, I think we all win where banks, fintechs, agency networks, even the regulators all collaborate to create what we call an interoperable space where through our multiple platforms, we can serve the customer through one interface. So the customer can have access to all these financial products, despite the fact that back end, they're operating on multiple systems, but the customer sees only one face, whether through your smartphone or through your feature phone.
Now, the biggest concern when mobile banking became quite a phenomenon here in Kenya was that banks are coming up with sort of products that then a lot of their customers are not aware of. So you'd find that so many customers have access to credit to an extent that they're taking credit when they don't necessarily need that credit. And I want you to take us through some of the measures that you think, where you think banks can do better in terms of creating products that then are impactful and not just easy to access.
Well, I think what comes to mind is that I think for a product to be successful and for people to aware, you must embed financial literacy. Not a lot of people understand finance. You think that it's simple, but we don't. It's something that you don't take for granted. So what we do is that whatever program or whatever products that we design, remember in designing products, we live in a very dynamic environment where consumer changes and requirements change rapidly.
Yeah.
So as you even design products, you have to keep monitoring it and tweaking it to ensure that it stays relevant to its end users. But apart from that is the digital literacy part of it, and we don't take it for granted. Digital platforms, again, using digital platforms, you can use e-module literacy platforms to basically teach things around cash management, pricing, digital marketing. It basically helps. And it helps the user understand these basic elements, and then they can now decide whether that product is really required for them and if they really need it. And if they do take it, how to use it, how to be responsible with it, and how to repay those products.
So how is digital and mobile banking then reshaping our credit scoring models?
Well, like I said before, typically or traditionally, you would need to have consistent revenue, cash streams. You must have collateral. Those basic things that people are always frowning at banks for, but they're critical in ensuring that a customer repays. And of course, equity contribution. Now, what digital banking does is that it looks at alternate data-driven credit models to come up with a lending product. And what does this mean? Is that you look at a user plagued with maybe irregular payment streams, no collateral, and poor record keeping. However, by using these alternate credit models, what you're now looking at is the mobile money transactions, utility payments, and supplier invoices being paid to basically create a credit worthiness profile for the user. So you can see that slowly you're moving away from the conventional method of credit scoring to basically profile a customer that would you want to be sure that would pay. And then based on that, you can now create a wraparound program around these data-driven models in order to ensure that these products are available for people that otherwise would not have qualified for credit.
All right, so Ralph, I want to paint a scenario for you, and this again is a conversation that is currently ongoing, particularly when it comes to things like SHA here in Kenya, where you find that I have an aging parent in the village, but because I send them money regularly, their credit perception based on their phone records then is very promising, but in reality this person has no income. So how can banks then navigate that and make sure that if we're going to lend to this customer, we know that we know the source of these funds, and we know that every month there is a certain amount that they are getting?
Well, that's the beauty of data. Data doesn't lie. So typically, with these sort of models, what you're looking at is that you can almost back check those data. Where are these payments coming from? What is the frequency of these payments? And then based on that, you're basically providing a credit program or a credit product that suits their need. And what do I mean by that? So we see the profile of your parents every month on the 20th, maybe because you're a salaried worker, you take a part of your salary and pay them. So on the 20th day of every month, they get a certain amount of money. Automatically, the algorithms around a credit model will say, okay, maybe we can begin, they are qualified to access 50% of whatever they're getting on a monthly basis. We see that these revenue streams are consistent, despite the fact they're not going to be fronting collateral, but you're giving 50%, and then with a short tenured repayment cycle. maybe they need for 30 days and things like that. So those are the kind of things that kind of information helps.
All right.
So by that, you're basically trying to create a digital credit track record or history for your parents in the village. And that automatically, from your hard work and sweat, makes them qualified to access credit in their own right.
All right. And let's move this conversation forward and talk about SMEs. What are some of the tools that you think SMEs can take advantage of, and particularly just in creating a credit profile that then they can present to a bank based on their digital and mobile banking records?
Well, I think I've overlabored the issue of using data-based credit models to profile SMEs. So that is one critical tool that is important in basically structuring products that will be ordinarily not available for SMEs. That's one. Now, embedded in that is that for most SME businesses, most of them require working capital type financing. And so that helps us create things like pre-approved overdraft programs, invoice financing requirements for their needs, and pay later type lending solutions to support them. Again, these are things that you create, you put it on these platforms and make it available for them, provided they meet those criteria, which in actual fact are data driven, right? So these solutions are available for them to use. So that's some of the tools that's available for them to use. In addition, based on digital banking, most of the platforms provide some level of digital accounting, i.e., these MSMEs can basically track their income, their expenditure, and these things provide digital receipts and other methods in which they can save, expense, and track things that will help their business move forward. Embedded in that, again, like I said before, is also digital literacy or digital learning programs that will teach them the basic accounting and record keeping requirements to help them keep their business on a sustainable basis. And then finally, we are looking at things around savings and insurance add-ons that they can use in order to ensure that their businesses are sustained.
So let's talk about bank to mobile and mobile to bank transactions. And I know you'll find that there are customers who feel that whatever amount of money I send to my bank or whatever amount of money I withdraw from my bank, that I will get, there's the fear of getting a negative listing because
a negative
outlook, because largely whenever I look at my bank transactions, it's largely withdrawals from the bank to mobile. It's not the other way around. Does that have an impact on my ability to access credit?
Well, again, like I've said before, it's important to have interoperable systems. And what that does is that it gives almost like a 360-degree view of your transactions and what you do. So typically, for you to even transfer from your bank to a platform means that you're also receiving money from somewhere, right? And then if we can link the receipt of funds to how you spend the funds, definitely we can map it. I do not think that it should exclude you from having access to credit. So we're very big on, and this is something that we've had from the central bank, particularly on the KYC aspect of financial inclusion. So for customers that are always sending money from their mobile phone to their bank account without necessarily identifying this is the source of this money. So how then do banks ensure that this does not become a problem? Well, KYC is important. We cannot underscore that. But what most central banks do is they give you leave, just because there's a need to promote inclusion, give you leave to tier certain banking systems. So for transactions below a certain amount, right, you can basically ask for the rudimentary documentation around that. But as the amounts begin to scale up, then there is need to provide proper documentation, government-issued IDs, and things like that. What the KYC, AML, anti-money laundering layer does is that you can embed it digitally into the products where you're backtracking flows of funds that come. And then as you backtrack it, you now begin to see or find out origins of funding into that particular account. So what that means is that banks must invest in critical tools. As you know, these sort of things bring with it inherent risks.
Yeah.
There are cyber threats. There are, of course, money laundering issues and questions around that. So it's important that, one, we invest in those kind of technology. Most importantly is the training of staff to ensure that at least they try to know the customers. Now, as you provide these products digitally, of course, you cannot know everyone because you're serving a large customer base. But transactions that spike, so for instance, I see that you're getting 1,000 Kenyan shillings a month, and all of a sudden you get 100,000 Kenyan shillings.
Yeah.
Definitely, the system has to trigger us to understand and begin to ask you questions as to what the source of money is, and then basically fill the necessary documentations to ensure that it complies with the KYC and anti-money laundering standards.
Which also brings in then another aspect, and this is the question around the balance between technology and innovation as well as protection of personal data.
Yeah.
How do banks balance this?
Well, one, again, it's a fine line.
Yeah.
Because ultimately, as you're trying to serve your customers and reach people, you don't really want to lose the human touch. So things around customer service is important, and customer support profiles are important, where you have a customer support team that are available and accessible 24/7, that can basically walk a customer through some of these digital products, one, or even how to even navigate an app, for instance. So that is some of the things that we do to ensure that human connection is not lost. Importantly, again, is that as you deal with digital transactions, it's important that you're transparent and have clear resolution mechanisms. And it must be dispute mechanisms. And resolution must be very quick, and must be transparent, and must be clear. And of course, the customer experience journey should not be broken. So you must have human interface to ensure that whatever journey that appears to be broken in that journey is restored.
Yeah.
So those are some of the fine lines we walk between digital and having a human face behind some of these things that we're pursuing.
Now, the one thing that digital payment has done is that we live in an era of instant payment.
Yep.
And I just want to know, how is this transforming liquidity for businesses and especially SMEs, and how can banks adapt to this?
Okay, well, which is why you have the buy now, pay later type transaction. So
Yeah.
again, if you're able to design a product that makes it available for SMEs or even individuals, it's important. So basically, you want to buy something, right? And you're trying to pay for it. What you're trying to buy is maybe 10 Kenyan shillings more than you require. The algorithm should pick it up and offer you an instant overdraft facility within your profile that you can actually utilize to make those payments instantly. Just based on the fact that the algorithm have picked up your inflows and requirements, or inflows or revenue streams into that thing. So I believe that those are things that are available to enable or meet the instant payments that are required from our customer base.
Now, there are other players in this ecosystem that we've not really talked about, and these are fintechs. Do you think today in 2025 that banks can survive without partnering with fintechs?
That banks can survive without partnering
Yeah.
with fintechs? Ultimately, fintechs have to bank somewhere. That's what I say.
Yeah.
But most importantly, is collaboration. I think that, yes, we compete, but there's a term called competition, and which is that you must collaborate in order to win. I think we're all better for it when we do it. Fintechs bring with them very advanced data analytics, digital onboarding capabilities, and ability to provide data-driven scoring models. Banks bring scale, bring trust amongst that thing. And I think that is a powerful combination when the two collaborate together, working with agency networks to reach the last mile. You provide information that makes banks create products that are flexible. You can change them quickly. They meet the needs. Remember, it's not just about having a bank account or transacting through bank. Ultimately, what we want is financial inclusion. And financial inclusion means that you're designing products that meet the specific requirements of the SME or the individual, right? And with partnering with fintechs, I think that together we can do that very quickly, scale it effectively, and ensure that we're doing it responsibly and sustainably for the environment as well.
So, Ralph, let me take you a couple of steps back. Do you think the fact that we can now be able to access credit on digital platforms and on mobile platforms backed by banks, does it then mean that these platforms are increasing NPLs for banks?
Well, again, it depends. You have to be very responsible in doing this thing. Yes, there could be the danger of increased NPLs, but when you design programs, you have to consistently monitor it to see what is working, what is not working, tweaking with whatever models that you've used in creating that product to ensure that you keep NPLs in check. Of note is that typically what banks generally do is to start with what we call a pilot program.
Yeah.
So you start with a pilot program, you test the market, you learn from the mistakes before you launch it out significantly. I think once that is done, where that is done, typically you keep NPLs low. I remember I told you when I was talking about Axis Bank PLC, we have basically the largest retail bank by customer base, but we have the lowest NPL in the industry at less than 5% amongst our peers. And we've learned to do that by really modeling and tracking and understanding the customer needs, the customer requirements per segment. So not every product can be used for a different segment. So you have to clearly define the segment, understand the customer profile, be very careful with designing the products, ensure that all the risk all the risk mitigants are embedded in that design program, test it in the market before launching.
And speaking of segmenting your customers, so can you just talk to us about the metrics that, for instance, you as Axis Bank are using to segment different products for different segments?
Okay, like I said before, we operate through two significant business pillars. One is the corporate, commercial, and public sector space, and then the other one is the retail. Now, within retail, you have various market segments. You have the employees in the value chain. You have the MSMEs. Even within the MSME space, it's scaled according to the turnover of those transactions. You have the ultra high net worth individuals. You have employees in the value chain. You have just the typical average mass market type. So in each segment, you have to, first of all, you have to understand how to segment. And part of the models that we do is that you have to understand the customer profile, understand what makes that customer fit within that segment, understand all the criteria, and then begin to take those criteria and then model a program or a product around it. So those are some of the things we do within the retail space. And then, like I said, we also live in a very dynamic world. You find out that even as you're modeling, some of those segments are changing. So someone that maybe you classified as a youth, after a while, it's no longer a youth, it's an employee. So you have to keep tracking the customer from when you onboard the customer all the way to the entire life cycle of that client.
All right, and I'll just remind those that are following this conversation that you can continue sharing in some of the questions based on the topic that we are discussing today, and we will be sampling some of them. We'll be posing those questions to Ralph, so keep them coming. Just in a few minutes, we will be going into that. And now, Ralph, I want to know, what are some of the challenges that banks are facing today in scaling digital solution, and especially in rural Kenya?
One, digital illiteracy is still a problem. Not everybody understands what's going on, how to use products within a smartphone. So a lot of work and a lot of campaigns are still required in order first to teach people about basic finance, then secondly, how to use and understand digital products. Embedded in that is also security. Because as you're bringing people into these things, you want to ensure that you safeguard their digital identity. You ensure that their phones are also protected. So campaigns around don't share your pins and things around that to help them is very important. The next again is infrastructure. Not every place has power or network that would ensure that people in the rural areas, in the furthest regions, can be reached. So no matter how excellent your product is, without basic infrastructure for networks and telcos, it's impossible to serve them. Trust is still very much an issue. Two parts of trust. Some people don't trust anything that is not physical. You're talking about digital. What's all that? It's up all in the air. I can't see my money. I want to feel. I want to touch. I want to feel the money. Right? So that's a basic requirement. The second part of trust again is that some people still want to go into a physical brick and mortar branch. So irrespective of what you do, they still want to see the branch manager, because seeing a building gives them some level of comfort to the safety of their funds. And of course, the issue of informality. As I've said before, we still struggle with regard to how you can provide services to a market segment that might not necessarily fit all the credit lending criteria.
Yeah.
Things around revenue, sporadic revenue streams, lack of collateral, no bookkeeping, things like that. So we still battle with some of those things. I think those are some of the challenges that we face within the space.
All right, and just to sample some of the comments that are coming back, a lot of great feedback that we are getting online. We have Bernadette Ngara, who says this is a great conversation. We have Charles Givenji, who says deep dive on financial inclusion and SME ecosystem. Well captured, very insightful chat from MD. That is from Kiama Olima. Haluia Wazir says great insights on digital banking and financial inclusion. So if you have questions, kindly keep them coming, and we will continue sampling some of them. So Ralph, again, for this small population that is yet to transition to digital or mobile banking, what then do banks need to do to bring them on board? Because as we go along, what we're beginning to see is that there's a very significant majority of bank customers that are doing all their transactions online.
Okay, first of all, to bring those customers in, remember, for a bank, cost to serve is key. It will be very expensive on our own to reach those market segments because as a bank, if I have to put a branch, it costs money. I have to hire people, put the technology to serve them. So what we do is to leverage on the agency banking network. And these are what we call the last mile markets that through their effort and through their reach, we can reach that particular population. So it's basically equipping them, ensuring that we provide the necessary solutions, working with the agency networks to provide those kind of services to people. Like I've said, in this space, one person can't own it. It's all about collaboration between the banks, between the fintechs, between the agency networks, between the telcos, between the utility companies. Together, working together, we can begin to reach that last mile. We want to reduce, like I said, Kenya has fantastic statistics where you say 84% have formal access to finance.
Yeah.
1 in every 10 Kenyan doesn't. We want to eliminate that one. Let it be that everybody has. And I think once we achieve that, it's a win for everyone.
All right, so there's a question that is coming in who says, how can SMEs leverage digital platform to access bank loans?
Okay, I think I had alluded to that
yes.
in the course of my conversation. And it's that, one, of course, they have to get on board in terms of signing on with the bank. Most banks have algorithms and data-driven credit models that can assess an MSME. Like I've said before, most MSMEs operate within the informal sector.
Yeah.
Not a lot of them have steady revenue profile. So a lot of banks have credit models that are suited to serve those MSMEs. So I think it's about, first of all, getting a bank account and starting from there.
Yeah. So, and in the space that we're in today, there's a lot of conversations around AI and deploying AI in different sectors of the economy. And I want to know, how then are banks leveraging AI to push financial inclusion?
Okay, so I would say that again, AI becomes very relevant in in the data-driven credit models. So what AI can do is to basically unveil much better the digital identities of a potential borrower, more than maybe the typical algorithm. Because guess what? In a typical algorithm, somebody has to impute, okay, so if this person earns X, maybe is qualified for 50% of that revenue stream. So what AI does is to monitor transactions across multiple platforms and in seconds build a credit profile for that customer. So that basically helps us provide service in a much quicker basis and a little bit more accurately, if not more accurately, than we see today. So those are, I think, the benefits that we can apply using AI.
All right, so the other big conversation, and especially within the financial sector here in Kenya, has been the high rates when you look at digital loans that Kenyans are getting, and the price of those credits. So what then needs to happen? Is it a regulation question so that we ensure that even for customers who are going and accessing credit on digital platform, that their rates are not as ridiculous, as exorbitant as they have been?
Well, I think the central bank is already doing that.
Yeah.
Already, I think this year alone, there have been about 4 or 5 rate cuts. Currently, the central bank rate is about 9.25, and chances are that the next meeting might come down again. But the Central Bank of Kenya has been working very hard to ensure there's transparency in the pricing model of most lending. They've now come up with Kesonia, which is the Kenyan shilling overnight interbank average. And what that does is that it acts as a reference rate that provides transparency when you're building your pricing models. But let's also remember that when we talk about Kesonia, there's a K, which is a premium. And it's in that we determine what the risk profile of the customer is and embed that premium. But the important thing that Kesonia brings on board is transparency. So the customer understands what the base rate is, how the premiums were computed in order to get that. And I think that with that, overall, the intent is that once you provide transparency in how you price your models, it will bring competition amongst banks and ultimately favor the borrower.
And it's a good thing that you bring up the aspects of Kesonia, because a lot of customers and their biggest concern that they have is Kesonia going to be translated even on digital loans? Is it going to be translated on my mobile bank application?
Yeah, I mean, definitely in working up the pricing models for digital products, you're going to use Kesonia. Like I've said before, it's about providing transparency. However, I have to emphasize the premium, which is key, because as we build our credit models, also we have to price in the cost of risk. And as long as we price in the cost of risk, that would reflect in the kind of rates that you get within these platforms. But definitely, what I always say is that as banks scale up in these things, you find out that the rates that you get on a digital platform or digital lending through banks are a lot much better than what people get in the informal sector, where people are charging on questionable rates. So either way, you find out that when you borrow money from a formal sector, ultimately it's much better, more cost effective for the consumer.
All right, so Ralph, a couple of years back, and especially when you started seeing a lot of banks investing in digital banking platforms, in digital banking application, there was this concern that maybe the digital platforms are going to lead to a reduction in jobs, a reduction in the number of branches, but that has not been the case. If anything, we're getting to a point where we're seeing a lot of banks then reinvesting in branches and reinvesting in having actual platform, that the brick and mortar banking. So could you just tell us the relationship between these investments in actual branches and still the investment in digital platform?
Well, we have to also look at the population growth of Africa. we continue to grow. So there'll be more need of banking services. There'll be more people falling within the band of being a bankable population. And so there'll still be requirements for more brick and mortar type branches. However, in providing apps and things, what you're now doing is that in terms of the workforce, they're becoming a whole lot more efficient. in terms of providing services.
Yeah.
Think about, I know that at the time when I was growing up, to go to the bank was a one day, you had to actually take an excuse from your boss for the whole day
Yeah.
just to go to the bank and just to withdraw your own money. And then back in Nigeria, where I come from, we used to have what we call the tally system. So you go to the bank, they give you a tally. Some people come with their maths, they have to sleep, you know, until the tally number is called before you can access service. Think
Yeah.
about what is happening today.
Yeah.
All you have to do is you wake up, you haven't even gotten out of bed, you get switch on your phone, and you can move monies around. But there are human beings behind those platforms. Human beings in terms of checking for security and ensuring that our consumers are safe. Human beings in terms of the developers and the human element that writes this algorithm. So there's still a need for humans. It's not necessarily going to lead in job losses. Rather,
Yeah.
it's going to make everybody more efficient in terms of and more dedicated in terms of serving the customers.
All right, and just to remind you that who's following this conversation, whether it's on X, on LinkedIn, or on YouTube, you can still send in your questions, even as we head to the tail end of this conversation. Now, Ralph, we have a question from James Mulwa on X, who says, I think banks need to create awareness among MSMEs on financial solution they have. There seems to be an information disconnect.
I agree, 100%. I'm not even going to agree. There's a lot more we have to do in terms of financial literacy. And so at Axis Bank and National Bank, what we do is that part of the offerings we do is even just financial literacy amongst even working class people.
Yeah.
You find out that a lot of people take it for granted. Things like common formulas that at least whatever you do, try and save 10% of whatever you earn. Put that aside. Just simple, basic things. Remember that ultimately, we're all going to get to a retirement age. Everybody has to retire. So it's now that you now have to start saving for those days. And then our job really is financial literacy around how to prepare you for that. Financial literacy on how to even use your physical mobile apps. Financial literacy on the multiple products that are there. That is lacking, and I think we need to do a lot more of it holistically.
All right, when you look at the population, particularly here in Kenya, which is also a representation of the population in Africa, which is largely at the median age of 19, 20. So do you think this population is going to force more digital products from banks?
100%. I think it's Gen Alpha.
Yeah.
We'll go to Gen Beta. So they are basically redefining the banking landscape and other landscapes. I think that there'll be more requirements for us to become more creative in terms of how we offer solutions that will meet their needs. Remember that in another couple of years, they will be the working population. And therefore, you have to provide for their requirements. If not, you lose out. And the way things are going, if you do not cater for it, they find a solution without you. So it's important that we take all the generations that make up different market segments into account in whatever products that we're designing.
All right, and when you look at the needs of the customers of today versus the customers of, let's say, early 2000, late 90s, how has that changed, and how are banks adapting to that based on the digital tools that they have?
I think one critical element that comes to light is sustainability. The younger generation want to hold everybody more account in terms of people, profits, planet. You could say that the other generation have been accused of pillaging the earth, so to speak. So it's all about responsible banking, sustainable banking, how you can draw products that help both the entrepreneurs and that effectively that will ultimately help the environment.
Yeah.
So I think that is one critical change and one critical demand that it's required in today's space as against the older generation.
All right, so for SMEs that are still very heavily reliant on cash, what do they need to do, and why should they then take a move to this digital platform, whether it's in accepting payments or making payments?
Well, I would say that we've come a long way. Yes, some still insist on cash, maybe based on trust factors, but there are so many options on what to do with cash. The agency network or the agent network is a way that they can take the cash off you, give you a digital receipt, and then it's in your account. Multiple ways that you can take cash, physical cash, off what you're requiring. Remember, ultimately, that there's the issue of security to you in holding cash. And banks today provide multiple options in which you can provide and bring your cash into the banking system. So I'd encourage them to please explore the options that are available to them to reduce the level of cash. Most corporates, most SMEs would always accept a transfer, a digital currency with digital receipts. Maybe for those that don't trust, at least they will say, okay, provide evidence that this monies have come through.
Yeah.
I would, while cash is important, but there are multiple options to basically transact seamlessly and digitally.
So, Ralph, there is a perception that digital banks, whether it's on a banking platform or on a digital platform, are more expensive than getting a bank from a branch. Is that correct? And if so, what needs to happen to change that?
More expensive. Well, think about it. Like I've said, you wake up, you're not even out of bed. You've moved money. Well, think about if you have to get into a car or get into a cab, you don't have to travel. I think if you look at the cost to serve, ultimately, maybe on the face of it, it seems as if it's expensive. But when you weigh the opportunity cost of having to physically go to transact the business, I think ultimately it's more cost effective than what it is. I think that we've taken digital banking and digital things for granted, but honestly, I think that it's come a long way. Like I've told you, I gave you a story about, I think when growing up, to go to the bank was a very harrowing experience. And then think about the time wasted in terms of either if you are an MSME, you don't have the time to spend somewhere else that is not helping you generate money for your business. So when you look at all these things in terms of the distance taken away, in terms of cost to serve, I think ultimately it's a cost-effective solution.
So essentially what I'm hearing you to say, Ralph, is that is the cost of convenience.
100%. 100%. I can't buy that anyway.
All right. There is a question from Angie Karma on X who says, if I default on a loan on the bank application, can that cause me to be listed on CRB?
Yes, ultimately. Yes, it will be. So, accessing digital loans is still a responsibility. Accessing a loan means you still have to repay. It's not a grant. It's not a gift. It's to help you solve whatever issue or requirement that you have. Again, as we always encourage as bankers, when you face a period of difficulty, always approach your banker and have a sit down. We are not terrible people. We are human beings. We understand. Sometimes things don't go as planned. But what I always encourage borrowers is that if there's anything, go and have a sit down with your banker. What it does is that it builds trust ultimately. And from a banking perspective, even though, at first we may not like it, but we'll walk you through how we can either restructure what you have to make it easier to pay in such a way that you can come out of it. And then when we do that, guess what? If you come back the next day and you say you want to borrow, I will 100% lend back to you because you've shown trust, you've shown a commitment to the monies that you've borrowed.
All right, let's talk about the risk. We've talked about all the positives that come with digital banking in as far as financial inclusion goes, but at the same time, digital banking carries a risk. Do you think the risk outweighs the benefit, or do you think the benefits outweigh the risk?
What I would say is that yes, it does come with risk, but we shouldn't be afraid. We should still accelerate what we are doing. However, you have to mitigate those risks. One, and you have to do it through security. It's very important, which is why if you look at the spend of most banks, significant spend around security, cyber security, data security, and things like that. It's really high. So we have to invest in one, online real-time cyber fraud monitoring solutions. We have to ensure that we are training our staff to look out for the red flags. Ultimately, we have to build a culture of shared responsibility where security is everyone's responsibility in that. We can't run away from it. Most importantly is that we also have to work with our regulators to ensure that we have a transparent and robust data governance framework where we can protect the digital presence of each user and encourage interoperable systems. It's very important that we do that. Yes, guess what? Every day, the business of banks is business of risk.
Yeah.
So you can't run away from risk. You can only mitigate the risk. And I think significant investments in these tools and, of course, in building a culture of security is important.
All right, and speaking of this risk, I want you to share maybe some tips with the customers and those who are following this conversation. The biggest risk that we see today is social engineered risks, and especially on digital platforms. So how then do customers mitigate against these risks?
We have to be careful, and again, going back to the point that our colleague in X sent out, a lot of investments have to be done in digital literacy or financial literacy. Things about not sharing your PIN, as you said, social engineering. I mean, I got a text saying that I was owing some money and that I needed to pay it quickly and I should just press the link. I mean, at my level, I'm getting nothing and I was panicking because I don't like owing anything, right? But I thought about it. I was like, this typically I'm not owing, and then I say I'm owing, and that's a link. Again, it's just based on where I've been, where they say do not click on links, do not share. Even if you click on it, for instance, don't share your pins. Things like that involves a lot of investments in financial literacy around that. We have to be very careful. Yes, people still fall victims to that, but it's important that we take out time. In as much as we like to create products and banks rush to provide products, we must embed financial literacy, how to use it, awareness around security and things to safeguard your PIN and digital profile.
And from a regulatory framework and a policy framework, do you think there's more that can be done to accelerate digital uptake in the country?
Well, I would have to commend the central bank. They're doing everything to ensure the safety of users, consumer protection, and all the policies and regulations that favor the clients with banks. Yes, the environment is changing, and of course, with a changing dynamic, regulations will continue to change. So I think that they are doing very well in terms of safeguarding both banks and our customers in that regard.
All right, and Ralph, as we wrap up this conversation, could you just give us more insights on what we can expect from an industry perspective in as far as investment in digital solutions go?
Okay, for us at Access Bank, as I've said, we have over 60 million customers. We have a purpose. We recite it every morning, every meeting, which is to make a positive impact in Africa. So we're not just a bank, we're a bank that believes in impact. So part of the success mechanism or criteria of a CEO is not how many transactions you've done alone, it's not how much money you've made, it's also how many livelihoods within your environment have you impacted, how many employment opportunities just based out of your products have you created. And those are the kind of scoring mechanisms. And so for us, it's not just about somebody opening an account and transacting digitally. It's about the impact behind it. One, did my product help create jobs just based on the fact that it helped your company expand? Did it help you? Were you formally excluded? Has it brought you into formal banking system? Those are the kind of questions we ask. And for us, that's our ambition, to ensure that we uplift the lives of Kenyans as we operate in this space. And we want to be known as the catalyst for change. And hence, we want to uphold our purpose, which is to make positive impact in Africa.
Do you foresee a scenario where we will have 100% financial inclusion, either in Kenya or in the continent? And if so, how soon or after how long?
Well, I think that's an aspiration. I don't know if it will happen, but we'll get closer to it. We'll keep pushing for 100. And like I've said, just based on statistics, when you look at Kenya vis-a-vis other African countries, at 85%, that is significant. And Kenyans and The government and regulators and all the stakeholders should be commended for that. But still, a lot of work needs to be done.
A lot of work to be done. Thank you so much, Ralph. Ralph is the country managing director, Access Bank here in Kenya. And that's all the time we have for you on today's episode. Remember, if you want to go and if you want to watch this conversation, you can go on the Kenya Bankers platform that is on YouTube. All the interviews that we have had, the past conversations are there. But that's all we have for you at this time. More of this conversation will be coming your way next Friday and the Friday after that. Keep engaging with us at Kenya Bankers, at Jim Cario, and with all our other partners. We'll be making sure if you have any questions that you felt have not been answered, send them our way, and we'll be getting that response to you at a time when we have the experts. So make sure to stay tuned for these conversations even in the coming week. Thank you for watching. My name is Jimmy Mbogo.